You know what's fascinating? While everyone's been watching gold hit record highs, something's been happening in the silver market that most people completely missed. And I'm not talking about the price action you see on your screen. I'm talking about what's happening behind the scenes. The kind of moves that don't make headlines until it's too late. Let me paint you a picture. Right now, as I'm recording this, there are institutional traders sitting in offices in London and New York who are looking at the same charts you and I can see. But they're seeing something different. They're seeing a setup that only appears maybe once or twice in a generation. And the smart money? They're already positioning. Here's what caught my attention last week. The silver to gold ratio just did something it hasn't done since right before the 2020 breakout. You remember what happened then, right? Silver went from $12 to $30 in less than a year. But this time, the fundamentals are actually stronger, way stronger. Think about this for a second. In 1980, when silver hit its inflation-adjusted peak of $150 per ounce in today's dollars, the world was using maybe 300 million ounces of silver per year for industrial purposes. Today, we're consuming over 600 million ounces annually just for solar panels alone. That's not counting electronics, EVs, medical applications, or any of the traditional industrial uses. The demand structure has completely transformed. But here's where it gets really interesting. The supply side is falling apart. And I don't mean gradually declining. I mean structurally breaking down in ways that can't be fixed quickly. Let me tell you about a conversation I had with a mining executive 3 weeks ago. This guy runs operations in Peru, one of the world's largest silver-producing regions. He told me something that should terrify anyone who's short silver right now. He said their all-in sustaining costs have jumped from $14 per ounce to over $21 per ounce in just the last 2 years. Labor costs, energy costs, equipment costs, regulatory costs, everything's going up. And here's the kicker. At current prices around $31, they're barely making money on new projects. You know what that means? It means new supply isn't coming online. The projects that would normally be developed to meet rising demand, they're not economically viable unless silver prices are significantly higher. We're talking $40, $50, maybe even $60 per ounce just to justify the capital expenditure and risk. Now, let's talk about what's happening on the demand side, because this is where the story gets absolutely wild. The solar industry alone is projected to consume over 200 million ounces of silver this year. That's up from 130 million ounces just 3 years ago. And every forecast I've seen suggests that number could double again by 2030. Why? Because every major economy on the planet has committed to massive solar buildouts. China's installing solar capacity at a rate that would have seemed impossible 5 years ago. Europe's accelerating their renewable transition. Even the United States, despite political headwinds, is seeing record solar installations. But here's what nobody's talking about. Each solar panel requires about 20 grams of silver. That doesn't sound like much until you realize we're talking about billions of panels. And there's no substitute that works as well. They've tried. Copper doesn't have the conductivity. Aluminum doesn't have the durability. Silver is irreplaceable in this application. Then you've got the EV revolution. Every electric vehicle uses between 25 to 50 grams of silver, compared to maybe 15 grams in a traditional car. And we're not talking about a gradual transition here. Major automakers are going all in on electric. By 2030, some analysts project that EVs could account for over 50% of new car sales globally. Do the math on that. We're talking about an additional 50 to 100 million ounces of annual silver demand just from the automotive sector. Medical applications are exploding too. Silver's antimicrobial properties make it essential in wound care, medical devices, and hospital equipment. Post-pandemic, the healthcare industry has become even more focused on infection control. Silver demand for medical applications has grown by 30% since 2020 and shows no signs of slowing down. Now, here's where this gets really interesting from an investment standpoint. Let me walk you through what's happening in the paper silver market versus the physical market, because the divergence is becoming extreme. The COMEX, where most silver futures trading happens, is showing something remarkable. The amount of physical silver backing those paper contracts has been declining steadily. We're now at a ratio where there are roughly 250 ounces of paper silver claims for every ounce of physical silver in the vaults. Think about that. If even 1% of those paper contract holders decided they wanted physical delivery, the system would break. And you know what? That's starting to happen. Delivery requests have been climbing. Not dramatically enough to break the market yet, but enough that the people who run these exchanges are getting nervous. I've seen the data. In the last 6 months, physical delivery requests are up 40% compared to the same period last year. Meanwhile, look at what's happening with physical silver products. Premiums on silver coins and bars have been elevated for over 2 years now. The U.S. Mint has been rationing silver eagles. Dealers are reporting wait times of 4 to 6 weeks for certain products. This isn't a temporary supply chain issue. This is structural tightness in the physical market. Let me tell you a story that illustrates what's really going on. There's a dealer I know in Texas, been in the business for 30 years. He told me that in all his time in this industry, he's never seen anything like what's happening now. He's got customers coming in wanting to buy $50,000, $100,000, even $500,000 worth of physical silver, and he can't source enough product to fill the orders. Not at reasonable premiums anyway. He said something that stuck with me. He said, "In 2008, we had a liquidity crisis. People needed cash, so they sold their silver. In 2020, we had a panic, but it was short-lived. This time is different. This time, people are buying and they're not selling. They're taking delivery and putting it away. That's not speculation. That's accumulation." And he's right. Look at the data from the Silver Institute. Investment demand for physical silver has been running at near record levels for 3 consecutive years. But here's what's really telling. Scrap supply, the amount of silver being recycled and sold back into the market, is at multi-decade lows. People aren't selling. They're holding. Now, let's talk about the elephant in the room. Central banks. You've probably heard about central banks buying gold. That story's been everywhere. What you might not have heard is what's happening with silver. While central banks aren't buying silver directly in the same way they buy gold, something else is happening. Sovereign wealth funds and state-owned enterprises, particularly in Asia, have been quietly accumulating silver through various channels. I came across a report last month from a research firm that tracks commodity flows. They identified over $2 billion in silver purchases by entities connected to Asian governments in the last 18 months. That's not official reserve buying. That's strategic accumulation happening through back channels. Why would they do that? Because they see what's coming. Think about the geopolitical situation for a moment. We're in the middle of the biggest monetary shift since the 1970s. The dollar's dominance is being challenged. Not tomorrow, not next year, but the trajectory is clear. Countries are settling trade in their own currencies. The BRICS nations are developing alternative payment systems. Gold is being revalued as a Tier 1 asset in the banking system. And silver? Silver is gold's little brother. It always has been. Throughout history, when gold moves, silver follows. But it doesn't just follow. It amplifies. In the 1970s, gold went up 24 times. Silver went up 38 times. In the 2000s bull market, gold went up about 7 times. Silver went up 12 times. The leverage is real. But here's what makes this setup different from those previous bull markets. In the 70s and 2000s, silver's primary demand was investment and industrial. Today, silver has become a critical strategic material for the energy transition. That changes everything. It means demand is less price sensitive. It means governments will pay whatever it takes to secure supply for their solar and EV industries. Let me give you a specific example of what I'm talking about. In 2022, when silver prices spiked briefly above $30, did solar panel manufacturers stop buying silver? No, they couldn't. Their production lines depend on it. They paid the higher prices and passed the costs along. That's what happens when something becomes truly essential. Now, I want to take a quick moment here because this is important. If you're sitting on $100,000 or more in retirement accounts and you're thinking about how to protect that wealth in this environment, I put together a free guide on how gold IRAs work. It's in the description below. It covers how you can get physical precious metals into your retirement account without triggering tax penalties. It's worth checking out if that's relevant to your situation. All right, Back to where this price is headed next. Let's talk about the technical setup, because this is where things get really compelling for anyone who understands market structure. Silver just broke out of a 3-year consolidation pattern. We've been trading in a range between roughly $22 and $30 since early 2021. That's a long time. Long consolidations lead to big moves. That's not speculation. That's market mechanics. The longer the base, the higher the potential move. But look at what's happening at the edges of that range. Every time we've tested the upper boundary around $30, we've seen massive paper selling come in. Futures contracts dumped on the market in minutes. Classic suppression. But here's the thing. It's taking more and more selling to push the price back down, and the dips are getting shallower. That's exhaustion. That's what happens when the physical market starts to overwhelm the paper market. The shorts are running out of ammunition. And speaking of shorts, let's talk about the commercial positioning on the COMEX. The big banks, the commercials who usually profit from suppressing prices, their short positions have been declining. Not dramatically, but steadily. They're covering. Why would they do that unless they thought higher prices were coming? Meanwhile, look at the managed money positioning. The hedge funds and speculators are actually relatively underinvested in silver right now compared to historical norms. That means there's massive buying power sitting on the sidelines, waiting for confirmation of a breakout. Here's what I think happens next. And I want to be clear. This is analysis, not a guarantee. But the setup is about as clear as it gets. We're going to see silver test that $30 resistance again. Maybe we're already there by the time you're watching this. When it breaks, and I think it will, we're going to see a rush of momentum buying. The algorithms will kick in, the technical traders will pile on, and most importantly, the physical buyers who've been waiting for confirmation will accelerate their purchases. The first target is $35. That's where we topped out in 2020 before the correction. But I don't think we stop there. The fundamentals are too strong. The supply deficit is too real. I think we're looking at $40 to $45 by the end of next year. And if the monetary situation deteriorates, if we see real currency instability, $50 to $60 is absolutely on the table. But here's what you need to understand. This isn't going to be a straight line up. There will be pullbacks. There will be shakeouts. The paper market will fight this every step of the way. But the physical market is going to win. It always does eventually. Let me tell you about 2011, because there are some interesting parallels. Silver went from $18 to $49 in less than a year. It was spectacular. But you know what happened? Most people didn't participate in the bulk of that move. They waited for confirmation. They waited for the breakout. By the time they bought in, we were at $45. And then came the correction. The people who made real money in that move were the ones who accumulated in the 20s, when everyone else was skeptical. They were the ones who understood the fundamentals and didn't need the market to validate their thesis before taking action. I'm seeing the same setup now. We're in the accumulation phase. The fundamentals are screaming. The technicals are setting up. But the crowd isn't here yet. That's the opportunity. Now, let's talk about the risks, because I'm not going to sit here and tell you this is a sure thing. Nothing in markets ever is. The biggest risk is a deflationary collapse. If we see a 2008-style credit crisis, everything gets sold. Silver would get hit hard in that scenario, at least initially. But here's the thing. Even in 2008, silver only dropped to $9 before recovering. And the recovery was swift and powerful. Within 2 years, we were back above $20 and heading to $49. The other risk is technological substitution. What if someone develops a solar panel that doesn't need silver? What if there's a breakthrough in conductivity that makes copper as effective as silver? It's possible. But I've been following the research. There's nothing on the horizon that's close to commercialization. We're talking years, maybe decades, before any potential substitute could scale. And here's the thing about silver that makes it unique among commodities. It's both an industrial metal and a monetary metal. That dual nature provides a floor. Even if industrial demand were to somehow collapse, which I don't see happening, silver would still have value as money. It's been money for 5,000 years. That doesn't just go away. Let me share one more story that I think captures what's really happening here. I was talking to a fund manager last month, guy who runs a $500 million commodity fund. He told me he's been in this business for 25 years, and he's never seen a setup quite like silver right now. He said, "You've got a supply deficit that's real and growing. You've got demand that's structural and accelerating. You've got a paper market that's over-leveraged and vulnerable. You've got geopolitical tailwinds. You've got monetary instability. And you've got a price that's still 40% below its inflation-adjusted all-time high. Where else do you find that combination?" He's right. This is rare. These setups don't come along often, and when they do, the people who recognize them early and act decisively are the ones who build real wealth. So here's what I'm watching in the coming weeks and months. First, I'm watching that $30 level. A clean break above $30 with strong volume would be significant. It would signal that the breakout is real and sustainable. Second, I'm watching the physical premiums. If premiums on coins and bars start spiking above 20%, that's a sign that physical shortage is becoming acute. That would be extremely bullish. Third, I'm watching the COMEX inventories. If we see a significant drawdown in registered silver, the silver that's available for delivery, that would indicate the paper market is under stress. Fourth, I'm watching the mining stocks. The silver miners have been underperforming the metal itself, which is unusual. When they start to outperform, when you see the juniors really starting to move, that's typically a sign that smart money is positioning for a major move in the underlying metal. And finally, I'm watching the macro environment. If we see the Fed pivot back to easing, if we see real concerns about dollar stability, if we see escalation in geopolitical tensions, all of those would be accelerants for silver. But here's the bottom line. You don't need all of those things to happen for silver to have a great run from here. The fundamentals alone justify significantly higher prices. Everything else is just potential rocket fuel. I want to leave you with this thought. In every major bull market in history, there's a moment when the opportunity is obvious to anyone paying attention, but the crowd hasn't arrived yet. That moment doesn't last long, maybe a few months, maybe a year, but it's there. I think we're in that moment right now with silver. The stackers, the people who've been accumulating physical metal for years, they see it. The smart institutional money, they see it. The question is, do you see it? Because here's the thing about these setups. By the time everyone sees it, by the time it's on the cover of magazines and your neighbor is talking about it, the easy money has been made. The big move happens in the quiet period, when the fundamentals are building, but the crowd is still skeptical. That's where we are now. The fundamentals are building. The technical setup is forming. The physical market is tightening. But the crowd isn't here yet. That's the opportunity. That's the final setup that silver stackers are seeing right now. The question isn't whether silver is going higher. The supply-demand fundamentals make that almost inevitable. The question is whether you're going to position yourself before the breakout or after. Whether you're going to be early or late. Whether you're going to catch the bulk of the move or just the tail end. I know what the smart money is doing. They're accumulating. Quietly. Steadily. Without fanfare. They're not waiting for confirmation. They're not waiting for the breakout. They're building positions now, while prices are still reasonable and physical metal is still available. That's the setup. That's what's happening right now in the silver market. And if history is any guide, the people who recognize it and act on it are going to be very glad they did.